Hello, today I'll teach you to 10 Elements of Business, Unit 2, Sources of Business Finance, Owned and Borrowed. Well, firstly, tell me what is the most basic thing needed to run a business? Well, I believe your answer is money. Right. Money is needed to carry out various activities of business. So the requirements of funds to carry out various activities of business is known as business finance. Now, what are the sources of business finance? So, firstly, what is the meaning of sources? Sources means from where the money or funds are owned or raised to run the business. Well, there are various sources of business finance. For example, one can raise business finance from bank loan or by issue of shares or through issue of debentures. Primarily, such financial needs for a business can be categorized in two categories, that is, fixed capital requirements and working capital requirements. Now, fixed capital requirements means capital is needed for long term and huge amount of capital is needed. For example, when a business needs capital to purchase plant, machinery, building, then it is called fixed capital requirements. Another term is working capital requirements. Well, when a business needs capital for their day-to-day activity, then it is called working capital requirements. For example, when a businessman needs capital to pay salary or to pay rent, then it is called working capital requirement. Primarily, there are two sources of business finance, that is through owned fund or borrowed fund. Now, finance can be raised through owned fund by issue of equity shares or preference shares or retained earning, whereas funds can be raised through borrowed funds by issue of commercial papers or debentures or trade credit or public deposits or leasing or factoring, etc. What is the meaning of owner's fund? The fund that is contributed from the pocket of the owner is known as owner's fund. Owner's fund can be raised through issue of equity shares or preference shares or retained earning. Now, what is equity share? Well, the funds which are raised by issuance of share is known as share capital. Well, there are mainly two types of shares, that is equity share and preference share. So, the funds which are raised through equity shareholders is known as equity share. Well, equity share plays a very important role in long-term financing of a company. Equity shareholders represent long-term financing of the company. Equity shares represents ownership of the company. Thus, the funds which are raised through issue of equity share is known as owner's fund or equity share capital or just capital. Well, let's discuss some merits of equity share. Equity shares provide a high rate of return. Therefore, investors who are ready and willing to take risk, they can go for higher profits. Now, another merit or advantage of equity share is equity shares does not put any burden on the company, as the dividend to the equity shareholders is paid only when there is some profit earned by the company. And the last merit of equity shareholder is funds can be raised through equity shares without putting any charge on the assets of the company. Now, as everything has some limitations, there are some limitations of equity shareholding. I'll discuss few of the limitations. So, as equity shareholder has a fluctuating nature, due to which many investors do not prefer to buy equity shares. The cost of equity shares are comparatively higher, and the process of issuance of equity shares is bit lengthy. Well, now I will explain you another source of business financing through own fund, that is financing through issue of preference share. Now, what is preference share? Well, preference share resembles debentures as they provide fixed rate of return. The capital which is raised by issue of preference share is known as preference share capital. Well, preference share receive fixed rate of dividend before any profit is declared for the equity shareholders from the net profit of the company. Well, at the time of liquidation, preference shareholders are repaid their capital after settlement of all the claims for creditors of the company. So, let me illustrate some of the merits of the preference shares. Well, preference shares provide regular income to the investors in the form of fixed rate of return. There is a safety of investment in case of preference shares. Preference shares does not or comparatively have a very low risk, and there is no charge created on any asset of the company at the time of issue of preference shares. Now, let's discuss some of the limitations of preference shares. Well, preference shares are not suitable for those investors who want high rate of return. There is no assured return in case of preference shares because dividend is paid to preference shareholder from the net profits of the company, and there is no guarantee that company will earn profit in the current year or coming years. The dividend paid to the preference shareholders is not deductible from the profit as expense. So, there is no tax saving in case of preference share dividend. So, this was all about preference share. Now we will study another source of business financing from own fund, that is financing from retained earning. Well, what is retained earning? So, retained earning is a part of net profit which is not distributed by the company as dividend to its shareholder. It is used for the growth and expansion of the business. It is a source of internal financing or self-financing or flowing back of profit. Well, let's discuss some of the merits or advantages of retained earning. Well, it is a permanent source of finance which is easily available for the company. It does not involve any explicit cost such as interest or dividend or any flotation cost. It provides a greater degree of freedom and flexibility, and it also enhances the capacity of business to earn more profit and to absorb unexpected losses. Well, let's discuss some of the limitations of retained earning. So, the availability of retained earning is not fixed as it depends upon profits of the company. If the company earns profit, then only it gets retained earning. Another limitation of retained earning is If company does excessive flowing back of profits, then it generates a sense of dissatisfaction among the shareholders as they are not paid their dividend. So this was all about own fund. Now we will discuss sources of business financing through borrowed fund. That is financing through loan from the financial institutions. Well, what are financial institutions and how loan is taken from the financial institutions? Well, the government has established a large number of financial institutions all across the country to provide finance to business organizations. They provide both own fund and borrowed fund in the form of long-term and medium-term requirements. They supplement the traditional financial agencies like commercial banks. As these institutions aim at promoting the industrial development, therefore they are also known as development banks. The financial institutions provide long-term finances. Now, let's discuss some of the merits of the financial institutions and how loan is taken from them. Well, financial institutions provide long-term finances. Many of these institutions provide financial, managerial, and technical advice to the business units. Well, obtaining loan from the financial institutions increases the goodwill of the borrowing company in the capital market. Consequently, such a companies can raise funds easily from other sources as well. The funds are made available even during the time of depression when other sources of finance are not available. Well, let's discuss some of the limitations of the financial institutions. Financial institutions follow a rigid criteria for grant of loan. Too many formalities are there, which makes procedure very lengthy and time consuming and even expensive. Financial institutions may have their nominee on the board of the borrowing company, thereby restricting the power of the company. So this was all for the financial institutions. Now we will discuss about loans from the banks. Well, what is the meaning of loans from the bank? Well, commercial banks occupy a vital position as they provide funds for different purposes as well as for different time periods. Banks extend loan to firms of all size and in many ways like cash credit, overdraft, term loans, purchasing or discounting of bills, and issue of letter of credit. Well, let's discuss some of the merits of loan from banks. Banks provide timely assistance to the business by providing funds as and when they need it. Secrecy of business can be maintained as the information supplied to the bank by the borrower is kept confidential. And the third point is the formalities such as issue of prospectus, underwriting are not required for raising loans from the bank. This therefore is easiest source of financing. Well, it also has some of the limitations like funds are generally available for short period and its extension or renewal is uncertain and difficult. And bank make detailed investigation of the company's affair and financial statements, etc. And may also ask for security of assets and personal sureties. This was all for loan from banks. Now we will discuss debentures. So, what are debentures? Well, a company can raise funds through issue of debentures. It bears a fixed rate of return. The debentures issued by the company is an acknowledgement that company borrowed a certain sum of money which it promised to repay at a future date. Debenture holders are therefore termed as creditors of the company. Public issue of debentures require that the issue be rated by credit rating agency on aspects like track record of its profitability, debt service capacity, credit worthiness, and the perceived risk of lending. Well, let's discuss some of the merits of debentures. Well, debentures provide a fixed rate of return and they are long-term source of finance. Debentures are fixed charged and therefore they do not participate in the profits of the company. The issue of debentures is suitable in the situation where sales and earning are relatively stable. As debentures do not carry any voting right, therefore financing through debentures does not dilute the control of equity shareholders on the management. Now, let's discuss some of the limitations of the debentures. As fixed charge instrument, debenture put a permanent burden on the earning of a company. Hence, there is a greater risk when earning of the company fluctuate. In case of redeemable debentures, the company has to make provision for repayment on specific date, even during a period of financial difficulty. So this was all about debentures. Now we will discuss the meaning of public deposits. Well, what is public deposits? The deposit that are raised by organization directly from is known as public deposit. The deposits are beneficial to both the depositor as well as to the organization. While the depositor gets higher interest rate than that offered by the bank, the cost of deposit to the company is less than the rate of cost of borrowing from the bank. Companies generally invite public deposit for a period less than 3 years. Now, let's discuss some of the merits of the public deposits. The procedure of obtaining deposit is simple and does not contain restrictive conditions as are generally there in the loan agreement. The cost of deposit is generally lower than the cost of borrowing from bank and financial institutions. As the depositor do not have any voting right, therefore the control of the company is not diluted. Now, let's discuss some of the limitations of public deposits. Well, new companies generally find it difficult to raise funds through public deposits, and it is an unreliable source of finance as the public may not respond when the company needs money. And collection of public deposit may prove difficult, particularly when the size of deposit is required is very large. Now we will discuss about trade credit. Well, trade credit is a credit extended by one trader to another for purchase of goods or services. Trade credit facilitates the purchase of supplies without immediate payment. Such credit appears in the record of the buyer of goods as sundry creditor or account payable. Trade credit is commonly used by business organizations as the source of short-term financing. Now, let's discuss some of the merits of trade credit. Trade credit is a convenient and continuous source of funds. Trade credit may be readily available in case creditworthiness of the customer is known to the seller. It does not create any charge on the assets of the firm while creating funds. Let's discuss some of the limitations of trade credit. Well, availability of easy and flexible trade credit facility may induce a firm to indulge in overtrading, which may add risk to the firm. Only limited amount of fund can be generated through trade credit. It is generally a costly source of fund as compared to most other sources of raising finance. This was all about trade credit. Now we will discuss about factoring. Well, the factor charges fees for the services rendered. Factoring appears on Indian financial scene only in early 90s as a result of RBI initiative. The organizations that provide such services include SBI, Factors and Financial Services Limited. Now let's discuss the merits of factoring. Well, obtaining funds through factoring is easier and cheaper than financing through other means such as bank credit. With cash flow accelerated by factoring, the client is able to meet his or her liabilities promptly as and when these arise. This provides security for a debt that firm might otherwise not be able to obtain. It does not create any charge on assets of the firm. Well, let's discuss some of the limitations of factoring. This source is expensive when the invoices are numerous and smaller in amount. The advance finance provided by the factor firm is generally available at higher interest cost than the usual rate of interest. So this was all about factoring. Now we will discuss about commercial paper. Well, what is commercial paper? Commercial papers is an unsecured promissory note issued by a firm to raise funds for a short period, varying from 90 days to 365 days. It is issued by one firm to another business firm, insurance company, pension funds, or banks. Now, let's discuss some of the merits of commercial paper. A commercial paper is sold on an unsecured basis and does not contain any restrictive condition. As it is freely transferable instrument, it is highly liquid. It provides more fund compared to other sources. A commercial paper provides a continuous source of funds. Now, let's discuss some of the limitations of commercial paper. Well, only financially sound and high-rated firm can raise money through commercial papers. Commercial paper is an impersonal method of financing. As such, if a firm is not in a position to redeem its paper due to commercial difficulty, extending the maturity of CP is not possible. So this was all about commercial papers. Well, we are nearing to the end of class. There are only few topics left. So stay here and stay with me. Now we'll discuss about lease financing. So what is lease financing? Well, renting of an asset for some specific period is known as lease. Lease finance provides an important means of modernization and diversification to the firm. Such type of financing is more prevalent in the acquisition of such assets as computer and electronic equipments which become obsolete quicker because of last changing technological developments. Well, let's discuss some of the merits of lease financing. So, lease financing enables the leasee to acquire the asset with a low investment. It is simple, and simple documentation makes it easier to finance asset. Lease rental paid by the leasee are deductible for computing taxable profit, and it provides finance without diluting the ownership or control of the business. The lease agreement does not affect the debt raising capacity of an enterprise. Well, now let's discuss some of the limitations of lease financing. Well, a lease agreement may impose certain restrictions on the use of the asset, and the normal business operations may be affected in case the lease is not renewed. And the leasee never becomes the owner of the asset. It deprives him of the residual value of the asset. Well, we are moving towards the last topic of this class. So, the last topic is on classification of source of funds. Well, it has been divided on the basis of period, ownership, and generation. Well, on the basis of period, it is divided into long term, short term, and medium term. Long term includes equity share, retained earning, preference share, debentures, loan from financial institutions, and loan from banks. Short term includes trade credit, factoring, banks, commercial papers. Medium term includes loan from bank, public deposits, loan from financial institutions, and lease financing. Well, now on the basis of ownership, it is divided into owned fund and borrowed fund. Well, under owned fund, it comes equity shares and retained earning. And under borrowed funds, there comes debentures, loan from banks, loan from financial institutions, public deposits, lease financing, and commercial papers. And now, on the basis of generation, it is divided into internal sources and external sources. Well, internal sources includes equity shares and retained earning, whereas external sources include financial institutions, loan from bank, preference shares, public deposits, debentures, lease financing, commercial papers, trade credit, and factoring. So this was all for this class. See you again. Goodbye.